Tech stocks have taken a beating, but some are an opportunity for investors, which are still good deals. Joining me now, Oakmark Chief Investment Officer for U.S. Equities and Portfolio Manager Bill Nygren. Bill, it's great to have you in the studio again. Thanks for joining us.
Thanks for having me.
So your approach to investing is to look for businesses that you think will outperform over the long term and to try to tune out market conditions. But still, I'm going to ask you about market conditions. Rising rates, but stubbornly high, good performance in the job market, despite the Fed's attempt to cool down the job market. How should investors be thinking about that dichotomy?
Well, at Oakmark, we've been 5 to 7 year time frame investors for more than 30 years. And over that time, there is always something in the macro environment that would encourage an investor to give up on stocks and think that they should not own them for a while. But over that 30-year period, the S&P 500 is up something like 15-fold. The odds are just against somebody who's trying to market time, and especially when they're trying to time after news is bad.
All right, so following on that, there's a famous Buffett quote about how price is what you pay, value is what you get. And when I look at the chart of your fund over the past 2 years, it seems like a good example of that. You dramatically outperformed your peers, at least, in 2021. You beat 96% of them. And then so far this year, you're beating 10% of them. The companies haven't changed that much. The market is putting a different price on those stocks. How do you think about that? How should investors think about that?
Well, in both years in the Oakmark Fund, we have owned a lot of companies that have very low PE ratios. And one of the surprises to us was when interest rates went up this year, we expected that to be good for bank stock prices. It's good for bank business fundamentals. But the recession concerns have caused the bank stocks to perform even worse than the S&P 500 has this year. And that's been a big drag on our performance. But we still own the stocks. We think the businesses are more valuable today than they were last year. And we expect them to be additive to our performance going forward.
And let's talk about a couple of stocks. I was going to focus on tech first. Alphabet, incredible company, obviously, a huge moat with alligators and crocodiles thrown in. But the market has not smiled on that company this year.
No. A lot of people think of Alphabet as a technology company, largely because of what they do in the other bets segment, where, Waymo, autonomous driving, that type of thing. But that's really not the core business. The core business is more like a typical media business that sells advertising.
Sure.
So this year hasn't been quite as good a year because that's a cyclical business. But we believe Alphabet is cheap, especially when you adjust for the assets that aren't earning money today, like the venture cap portfolio, like the cash on the balance sheet, and an undermonetized YouTube. We think it gets down to barely a double-digit PE on the search business. And
there's room to trim there, some people think. Maybe it's a little bloated on the employee side?
Possibly so. Okay. I think a lot of the technology companies that have been investing for supernormal growth going forward have pulled back a little bit this year on the employee count.
Let's look at another example of that, Facebook. I've got to say, the corporate governance there, not very pretty, and Mark Zuckerberg betting the farm on the metaverse. Are you in on that?
We do own the stock. But unlike some other value investors, when a company has really disappointing news that we think affects the fundamentals long term, our knee-jerk reaction is not to add to the position. We take a pause, we meet with management again, we represent the stock as if it was a brand new idea. And we're concerned about the magnitude of the spending on both artificial intelligence and the metaverse. And it's to be determined what happens to our position from here.
Let's transition to a very different sector, that is energy. That's the only really good sector this year. You own a company called APA, which Barrons has written favorably about. Can you explain that company? It's the former Apache, and why you like the stock?
Sure. It's a large domestic oil and gas producer. We think the industry has been tremendously underinvested in for the past decade. And supply and demand has finally turned very favorable for oil prices. And it's going to take years for the oil companies to respond to that and meet increased supply. So despite the increase this year, APA has a free cash flow yield that's double digit. And even relative to 4 or 5% bonds, we think that number is very attractive for investors. And that's coming back to investors as dividends and share repurchase, which is an important change for this industry.
Bill, I've got to let you go because we're out of time, but real quick, you and I spoke about Netflix a year ago. Since then, the advertising experiment has started. So far, so good?
Yes, I'd say so far, so good. One of the things Netflix has going for it is people watch so many hours of Netflix when they subscribe that it gives a lot of advertising opportunity. So they can make that price very attractive to consumers who don't want to pay a full monthly fee and aren't really annoyed by the interruptions of the ads. So we think it'll increase their market.
Binging is good for advertisers. Bill Nygren, thank you so much. Appreciate your being here.